Yeah, welcome to our first Santiment seminar. So today Jan will be presenting. Uh, and he'll be talking apparently about time series analysis. So,
Exactly.
yeah.
Exactly. So yeah, as I said, the thing is, I kind of want to focus in terms of time series. I kind of want to focus not so much on the model side, on what kind of models, time series models you would want to use, because in the end, typically that's easy to research. You can just look that up. What I kind of want to focus on more is maybe a bit of um, the things you need to look out for when doing time series analysis, the things you kind of want to focus on, and of course, like a bit of my like an example of my research in general. So that's kind of the idea. It kind of developed more into this, like what to look out for, kind of the issues that you want to address, um, and less on the model side. And having said that, let's start with a model, I guess. Okay, so as I said, let's start with the basics. The most simple model that you have in statistics and machine learning, for that matter, is the regression. So it's like the simple fitting a line to it, ax plus b, fitting to the data. You have your height and weight, and want to look, is there a relationship between height and weight? Taller people more heavy typically? Um, that would be like a question of statistics. And in terms of machine learning, where it's also basically the simplest model, the idea would be, can I predict the height or the weight from a given height? Um, on top of that, basically that's the whole math behind it. The message behind that is basically just that um, it's basically solvable. You don't have to fit anything. You can just do the calculations, which is also amazing because you basically is super fast. And on top of that, you have the multiple regression, which basically just adds different or more variables to it. So the equation would be a plus bx1 plus b2 x2 and so on. In the end, like there's also this kind of plus e, which is the error term, which is not in the statistical, well, it's not being fitted basically, but it's in the model as describing, there's some error to it. Why am I telling you this again? Is because basically in economics, more or less everything is a multiple regression. Everything is being expressed as a linear model in the general economic science, and this is typically like whenever you hear something like a capital asset pricing model or autoregressive model, ARIMA, in the end, basically behind that is always this kind of multiple regression model. This is always going to be kind of the more or less the output. For the people who don't know, typically the most important data or the most important outputs that you're going to look for is the R squared, which is basically showing you the explained variance. So in other terms, you could call it the basically in this case you would have like around 49 or 50% of the total variance of the data points explained by the model. This is typically what you want to go for in economics. Typically, like what people go for is like an R squared of 0.7 or higher. This is kind of interesting. And also the p-value, which is basically the question of, is it significant? So is it really important? In this case, you would have your features that you include, and then would want to know on top of like how much does it explain in terms of variance. You would also kind of want to know how important actually is every feature. And statistically speaking, you kind of want to have a p-value below 0.05. Not really mathematically correct. You could argue that this is something like there's a less than 0% chance of being wrong. In really mathematical terms, this is or or statistical terms, you would need to express it as something like if you would reproduce this experiment 1,000,000 times, you would only in 0 or in 5% of the time you would get different results. This is kind of the mathematically correct way to express it. But generally, these are the things that you're looking for. Are the features interesting? Do they add additional value? And how much total explained variance do you have in your model? Exactly. And so generally speaking, a lot of the time what I saw is like people divide how to apply these models in time series in kind of this like two kinds of ways. You would have your general like these autoregressive models, which basically look at previous dates to predict or to analyze the current value. So is today's value dependent on the previous ones? And on the other side of the spectrum, you have your kind of factor models, which would look at features. So you want to have, in this case, your market cap explained by, for example, daily active addresses and some other metrics. So these are kind of like the different ways you can look into time series, A, historically on past data, or B, on a more vertical level or horizontal level in terms of other features that move into this, which I find kind of fascinating because it's typically also the kind of two fundamental schools in finance and investing. You would have your technical analysts, which basically say, look at trends, at double tops, trend resistance lines being broken and all that. Basically saying, tell me the past and I'll show you the future. And on the other side, you have your fundamentalists, which basically say, okay, the history is totally uninteresting. It's absolutely about what the asset or the company or whatever is currently, what state it basically is in. So this is kind of representing these two extremes. But of course, if you think about it, it's very much possible and easy to have combined ways of including past values and of course like some features, and yeah, probably should be used in this kind of sense. There's also this kind of thing that doesn't fit in there totally. It's like this time series decomposition, which is basically a way of decomposing a time series into the trend and the seasonality. I'm just bringing that in because it doesn't really, like seasonality especially doesn't really fit or fits both criteria basically, because that way seasonality is interesting because it's or periodically, so like a reoccurring pattern basically, because it can be expressed in terms of past data. Has there been like every second day there is some specific pattern or something, or can it be expressed in terms of features, which would be, for example, Mondays, like day of the weeks. Are Mondays typically better in returns, for example, which they apparently are. We just looked at that, and Mondays and Saturdays are typically the best in terms of crypto returns, just as a side note. Generally, as I said, like I'm not going too deep into these models that we use, simply because you can just look that up and use it yourself. So ARIMA is more of a real time series model where you look at previous days and basically regress over them. You have your, as I said, regression, which can be used in different ways. Ridge regression is kind of interesting because it's basically or lasso is a similar concept. Because it's basically a regression that is being punished for having too many features. So by nature, the algorithm will try to get as good as a fit as possible with as little features as possible, and that's a lot of the time used in machine learning and in statistics in general to reduce feature size, which for us might be or tends to be interesting. K-nearest neighbor is a classical classifier in machine learning, even though it's not technically learning something, it's just looking at the Euclidean distance between data points and looking, if you want to predict some data point, you look which, in terms of features, which has the closest Euclidean distance of the previous data points that you've observed, and then classify according to that. Fast Fourier transformation, I think you've heard about that maybe. And your classical, your classical machine learning models, which is decision tree models, so random forest and boosting, and neural nets, both being like the classical, machine learning stuff. In typically, like in this kind of area of stock price forecasting, analysis, prediction, a lot of the time people want to go for the smaller decision tree models and not so much the neural nets, simply because neural nets need a ton of data, and a lot of the time, in current state of crypto, for example, we just do not have that.
Before we continue, can you maybe explain a little bit more? So first of all, what is a model?
All right, so model can technically be anything that, in a sense, kind of is trying to represent your data. Also, there's kind of this difference for me. Typically, a model is as we see here, kind of like a method of analysis. In typically economics, you would have a model would almost always be a regression, just used in different ways. So a model is also kind of like used in different terms, but in general, it's kind of a way to describe how you see the world in a simpler way, basically. A model is always simpler than the real world, and a model is always, there's the saying, a model is always wrong, but some of them are useful. So
okay, so just like one example, if you take a look at, for example, the position of the moon, so you can watch every day or every hour where the moon is on the sky, and so you can record lots and lots of data. And so this is data, and the model for this data is the laws of gravity. So they represent some very simple description of those positions and how they change over time. Is this correct?
Yes. So yeah, a model can be pretty much everything, as long as it's kind of trying to, like explain the core concept of the system.
Okay, and so a time series models, can you, like, you said you don't want to go too much into it, but if you can give at least one example of a time series model before we can talk about what are the problems with, so what to watch out.
So yeah, time series generally refers to data points that are distributed over time, which kind of brings a lot of additional things you need to be aware of with it, especially since these data points are typically not independent. So every point in a stock price development kind of depends on the previous one. So it's not just flying all over the place. If the price of a stock is 10,000 today, it will not be 1 tomorrow, probably, hopefully. And so a time series model on top of that can try basically everything to describe it. It doesn't even need to be reliant on in my personal opinion, like, of course you can discuss about that, what really defines time series models. But basically in the end, you're trying everything to come from different ways to describe how things develop over time, or what moves things in its core, basically. So you can kind of, as you see here, you can kind of make that dependent on the previous data, or you can kind of make that dependent on its current features.
Okay, so basically an autoregressive model is just some kind of a rule which we can use to guess the next value based on the previous values. Is this correct?
Yeah, yeah.
Okay,
exactly.
and the factor model is a rule which allows us to guess the current value based on some other features, like in your example, to try to guess the market cap from the daily active addresses for it.
Exactly. So,
okay.
Yeah.
Okay, thank you.
And yeah, basically you can use all of these more or less, you know, for example, in your neural nets, basically, typically what's used in time series is some kind of recurrent neural net or long short-term model, long short-term memory model, which is basically incorporating past information into the model. So instead of just using the current information, the current features that I'm getting, it is also including historic or older inputs, basically. And typically when we do time series analysis, I kind of feel like it helps to do, first of all, define what you kind of want to do, which could be just pure description. So, you know, just purely describing this price has gone up, this trend has been going up for a while now, or something like that, which is absolutely fine. We are doing that a lot. We're just delivering some descriptions of how the market is, how big it is, how it's moving, how it behaves in relation to other markets, for example, at the given point. Then there's like this kind of attempt to explain, which is typically in a lot of economic models. You would try to explain the returns of a stock, for example, by the market return plus maybe some other, like the famous Farmer French three-factor model would try to explain returns using the market, I think the size of a company and its price to book ratio, if I remember correctly. So this is kind of like a thing that is not trying to predict anything in a sense. It's just trying to explain how certain features in a market move together or are related. And the third thing is, of course, like kind of the holy grail, which would be forecasting in the end, trying to predict like where is it going next. There is actually not a lot of stuff that is really going too deep in terms of resources, going too deep into really, you know, using time series analysis to predict and forecast stock or other asset prices. Basically, there's this one hugely famous book at the moment from Marcos Lopez de Prado. I'm hoping I pronounced that correctly, which is basically the only book, at least that I know, that is addressing this whole, you know, can you use machine learning actually to use in finance to predict stock returns or to you know, generate strategies in terms of investing. So this is kind of interesting, and I'm also trying to incorporate some of the ideas from this book, maybe to just mention them and maybe give you some ideas of what to look out for. Generally speaking, this would be kind of the process that you're going through in terms of when you kind of want to do analysis on, you know, crypto assets or financial assets in general. You would try to first get an understanding of the market, of the assets, you know, plot some stuff, visualize it, see what maybe might be correlated, get an understanding, and generate some theories about that. Typically in the scientific, yeah.
Guys, sorry, may I ask a few questions?
Yes.
You mentioned the 3 points. Unfortunately, my connection, I'm on a train, was not so good for the first one. Can you repeat the first one? The second one was like to explain. The third one, to predict. What was the first one?
To just describe. So you're basically just saying, okay, this is happening in the market right now, which is also important.
You mean like a chart version? This is the price. This is the volume. This is
Exactly.
all this time series. Okay,
Exactly.
then the next level of complexity, we say, well, they're connected in a way, and in 80% of the chains, they do correlate or explain the price. And third one is magic,
Exactly.
esoteric, where they say, you know what, we know how to predict it.
Exactly.
We know the future. This is correct.
This is kind of the process to get to maybe the.
Okay, good. Okay, cool. Cool. So, 'cause you mean it like makes sense that if we like proceed with data series or any other analysis, we like take it as a framework. First two, three. Yeah. And I would just mention, because I think I need to lose the train like shortly. One thing that we don't lose our time and effort on something which is not worth our effort. The third thing about predicting a holy grail, in the majority of cases, especially in the crypto market, it's a chaos. Chaotic, I mean, it's irrationality of how market behaves, and I don't believe there is any reliable predicting model. So I would not like us to spend too much time on it. It's like it's okay to play around, and it's fun. Sometimes there are models which are working for some period of time. I could give few models and we could describe few models which are working very good in the bull market, initial, final stage, or in middle of bear market. The thing is, it's very hard to say, are you in a bull market or are you in a bear market? So, but the models themselves, there are, it's just they work and then they don't work and you don't know where the switch happens. And this I know like from 10 years of what I'm doing in crypto markets, or 10 years in general markets instead of crypto, just to make it clear for us. And but the second one, which you say, explain, this is I think where we can really be very powerful. There is explanations, there are correlations, there are more and more data points, time series, which do explain why things are happening, what is the price, and I think we can be very strong in it. Okay, anyway, just a few words, and now I'm excited to get.
I kind of agree, but just wanted to mention that it seems that, like from what I've heard from Jan, that we actually have some small results about forecasting, but just not in long term, but maybe in for the next day. Sometimes we can maybe do a little bit better than just pure chance.
Yeah, exactly. So both true, definitely.
That works. It's just don't and okay.
What? Yeah. So. Yeah, exactly. So generally, I'm definitely on the same side here. This is basically the thing that forecasting, of course, like very difficult, and in the end, all of these three things make a ton of sense, basically, to me. And like I think the next slide is actually kind of interesting in terms of that. So the process in this sense would be after visualizing, generally generating theories, which would technically in the scientific process also include generating, like reading previous research and basing upon that. We just in the crypto space have the issue of there's not really a lot of research being done. So that would lead then to your classical modeling, where you're trying to generate some kind of model based on top of that, and then in the typical statistics, you would then evaluate how good the model fits, and that's it for statistics typically. So the usual statistical model just tries to generate insights by proving that a model somewhat fits the data. Machine learning goes a bit further and then tries to predict actually for going from a model trained on some training data, and then goes to some other data, some test data that you set aside before, and tries to actually predict that, and then looks, is the prediction actually good? Both can be used for strategies, for example, or for testing, back testing, because in the end, like a statistical model would give you something like, okay, this is correlated to that. When this happens, typically something moves in the market or something like that. And you can backtest that, basically. You can test that strategy on data in the past and see if it would have worked. And machine learning would typically give you like a model that does prediction in terms of predicting the price, predicting returns or whatever. And you could then also backtest that. So this is kind of like how this thing works together. And your typical statistical model kind of fits to what Maxime also says. You're just trying to understand what's happening in the market, which is why I'm also typically all for the general statistics or the statistical approach, because that is kind of the insight generating part or the knowledge generating part. While machine learning models oftentimes tend to be black boxes. They predict something and they might do that well, but a lot of the time you just don't know what they exactly do. So yeah, these are the basically the processes, and in the end you would have your back test, for example, to see might a strategy work, and maybe even below that you could say that you then would go on to so-called paper trading, which means you would follow the current market and make decisions based on that, and just note your theoretical trades or real trades, if you want, on paper, and see how it really would have worked. That's kind of the raw structure of it. So some things about time series in general, and especially for financial analysis. Typically, a lot of models assume stationarity, meaning they kind of move around a mean, so they don't have a trend in them, which is of course problematic for stock price or crypto price predictions, because they definitely move. So a lot of the time what people go for is going for the returns, which means like the percent change instead. So not looking at the overall price development, but like how much did it change in a day in terms of percent, and that technically should always revolve somewhere around the mean, so that should be stationary. But also a lot of modern there's like a huge discussion about that. Is that really the best thing? Because if you're just looking at returns, you kind of you by definition take out the trend, and the trend is an important part of it. So a lot of the time people now trying to leave the trend in, or at least to a degree, and there's methods for that. Classical next thing is the look ahead bias. So basically you include some information in your analysis, in your back testing, for example, that you shouldn't have at that given time. So classical thing was when for example you try to select a portfolio of crypto assets out of the current top 50 projects and see how that performs. The thing is, like, what's currently in the top 50, you didn't know that historically. So if you test that on historical data, of course, these top 50 right now will perform quite well historically, simply because they are the top 50 right now, right? So this is like, it's stuff that goes in easily and is overseen easily, and is quite dangerous because it gives you like amazing results, and in the end it was maybe nothing. In terms of machine learning is also like the classical issue of how do I do a train test split? So if I have some data and I want to train the model on and then test it, how it performs on some other data, how do I actually split that? In regular statistics or in regular data science, you would just select a random sample out of that. But since it's time series and it's dependent on each other, that is kind of also problematic, especially if you're looking at price. Returns kind of helps with that, because returns shouldn't have a memory more in a sense, but it's also very, very difficult. So the optimal thing would, of course, like to have like a historical train set and then something, a test set that comes later. But with crypto, you kind of have this, it goes up in the recent 2 years, it goes up and then it goes down basically. So where do you split that? Where do you train your model and where do you evaluate that model? So this is kind of a difficult thing you need to kind of look out for. The optimal solution would, of course, be, you train your model on the data we have right now, and then you wait for a year or something, and then you test your model on that. But of course, that is also kind of has some obvious issues with that. Features. Features meaning like the variables you look at. So daily active addresses, transaction volume, GitHub activity, all that stuff. So in terms of like the features you want to include, is that the issue is that you're typically, if you're looking at a table, at a data frame, as I said, like if you're looking at returns and trying to predict returns, and then you don't really have any kind of momentum included in that, which is like the backbone of, for example, technical analysis. If you don't have the history in it, then how can you predict something? And this is kind of the issue, that most models just go through a table column by column and just look at that and don't look at the overall development of the metrics and the features, which like there's models, for example, like recurrent neural nets, which take into account past events. There's all other ways in terms of, the easy ways is just to include like a moving average, for example, as a feature, and that would give you like how has it performed in the past 10, 50 days, or even just give it as a feature in your column, the price of or the returns of the last day and the returns of the day before that and before that, to include that. But these are ways basically to include your momentum, even if you're just trying to predict returns, the percent changes. Next one is kind of advanced. This was something from this book, Advances in Financial Machine Learning, where he said, is even time in the time series really the best thing? Because there is times where basically nothing happens in the market, and then there's times where a ton of stuff happens, and a learning model will try to predict something even if there's nothing there. And so there are ways of crunching the data in a way that you don't have time as the time basically, but you have an amount of dollars traded, for example, or an amount of transactions being done, or something like that. That's kind of advanced, but this is also interesting to keep in mind. And of course, like the thing is also what to predict. What do we actually want to predict? If we want to predict, of course. And the thing is, first of all, there's this huge like beginner's mistake that they just want to predict the price, but since it's all in the column, like today's features and today's price or price change, you kind of predict today's price from today's features, which is of course not so great. If you predict today's weather from looking at the weather today, it's not so impressive. So this is kind of first of all, you kind of want to lag or like move the timeline around a bit, so you're basically trying to predict at least tomorrow's return or tomorrow's value. That is kind of a rookie mistake. But the more advanced thing on that is basically, is tomorrow's return really also a good thing that you kind of want to predict? Because a metric like, I don't know, the network growth or something, that might not be good to predict tomorrow, but it might be good to predict, something that happens in the next 10 days. So this is also something that a lot of people like intuitively do, which is just, predicting the next day. But in the end, you kind of want to look broader, and there's also methods to do that, to include that, and we're looking into that right now. So they all have issues, but one easy way would maybe to look do not try to predict tomorrow's return, but the overall return for the next 10 days, and include that in your column that you predict, basically. So this is stuff you kind of need to look out for. A thing in statistics in general, an issue for more the statistical area is the so-called alpha inflation. So meaning whenever you test something, you do a significance test, for example, you have your, as I said, you have your 5% chance of being wrong, more or less. But if you do that over and over and over again, there's a high chance that you actually will get something wrong at times. And in other words, basically, the more you look at data, the more destined you are to not find something that is really there, but just to find random combinations of things. Like in machine learning, that would be called overfitting, meaning that you're modeling something that is really not a true thing, that is just something that happened because you're looking at so little data that this coincidentally falls together. And statistics has been like basically the whole science of statistics is trying to avoid this. But like in a sense, we are kind of in a tight spot here, since we simply do not have a lot of data. I think on the next slide I go a bit more into that. As I said, like the same thing goes for machine learning. You kind of machine learning assumes that it's avoiding that by basically dividing things up in a train set and a test set. So you're training your model on one thing, and then you're not testing it on the same data, but on some other data. And that is true, that works, that helps prevent this kind of overfitting, this modeling something that isn't really there, that's just coincidence. But in the end, like since we do have not so much data points in terms of pricing, if you do this over and over again, basically, this is something that happens in the Kaggle competitions as well. I don't know if you know that, like this is like the big platform for machine learning predictions and all that. And they basically also, like once you test something on your test set over and over, you train it on your training, and then you test it, and then it doesn't work, then you tweak your data a little bit, your model a little bit, and then you test it again on the test set. And so you're also training on the test set, and that basically means that you're again overfitting. So this is kind of the issue that we're also facing in our case. And like a lot of time people say, well, you have tons of data, right? But in the end, what you kind of want to look at is the price, right? Like the price change. And we don't have a ton of that. Simply historically, there's like, especially for some ERC20 tokens who only exist for half a year, you don't really have a lot of data. And since all of the crypto assets are very correlated, you can't even, try to diversify around that. And in the end, you also kind of want to say, okay, some really, advanced financial trading behavior only occurred after like the big scale investors came in. So you probably kind of have a time frame that you're looking at from, typically we kind of like to start from beginning of 17 to now. So that's not a lot of data points, especially if you're looking at daily data, for example. And especially machine learning models just need a ton of data to train. Basically, statistics has always been around trying to model as simple as possible. Basically, this whole Occam's razor thing, try to have the model as simple as possible. While machine learning said, well, we have so much data, we can just throw a ton of huge models and with thousands of parameters added, and that will work too. But in this case, like in this kind of financial analysis here, you actually don't have a lot of data. So I kind of try to stay away from a lot of machine learning as long as I can, basically. again, like also this kind of issue with machine learning is that you a lot of the time have very black boxy models, meaning it learns something, but you're not really sure what it had learned. So that is also not the greatest thing for me, for example, since I typically want to publish articles, research, gain insights, and there's not a lot of insight gained from we just trained a huge network and it predicted something. So this is kind of like my point in this area. Generally, things that you need to watch out when you're doing data science or like analysis on crypto data is kind of this thing of, first of all, what do you benchmark against? Like when you're testing, for example, you come up with a strategy, what do you test it against? Is losing 10% good in a bear market, or is gaining so-and-so? So you kind of need to be aware of what do you benchmark against first. So typically I try to use Bitcoin as kind of the market in itself, as a benchmark for strategies. You kind of want to beat just holding Bitcoin basically for every strategy. Or Ethereum might be an interesting benchmark, for ERC20 tokens, of course. And you kind of want to, if you have trading strategy that buys and sells, for example, you kind of want to benchmark that against just holding it, maybe, because a lot of the time, especially if you include transaction costs to it, because for every buy and sell you need to pay a little, so you kind of, in the end, a lot of the time you end up being worse actually if you count for transaction costs. So in terms of I think I've already mentioned like this kind of time frame issue that you have, like what do you want to look at. With our assets that we typically look at, you also have the issue that these start at very different points. So you want to kind of compare or generate portfolios out of ERC20 projects that we have, for example. You still have you're kind of limited because they sometimes only exist for 6 months or so. So this is kind of limiting if you want to compare projects. Granularity, the question you kind of need to think about. But yeah, for us, daily data kind of makes sense. Also kind of like what projects do you want to choose to compare, for example, and if you have a strategy, what kind of projects do you want to test them on? Do you want to test it on basically all, which, as I said, like has some issues with where did they begin? Also, we technically don't have, we have a lot, but we don't have them all in our database. So yeah. Or for example, like the top 50, I just mentioned that if you take the current top 50, that's also going to be an issue, right? So you kind of want to maybe go back and take historically back then the top 50 and then rebalance your portfolio and stuff like that. Yeah, and last thing is basically right now we're using the closing price, which typically makes sense because if you're calculating returns for the next day, the percent change for the next day, for example, you kind of want to calculate it from closing price to closing price. So today's closing price until tomorrow's closing price is the percent change from tomorrow. This is just like a thing to watch out for, that you typically want to not average prices if you're doing this, but you kind of want to have the closing prices. So just a best practice. Backtesting, I think you should all know about that. It's basically testing, and I've talked about it, basically testing your strategy and simulating it on data from the past. So what if I had traded back then? How would I have made? How much money would I have made? Maybe important to know, you can basically 2 ways backtesting can be done, like a buy-sell strategy, where you basically say, I buy every time this kind of signal gets triggered. So this could be for one one asset basically. But you could also do in a more quantitative way. If I say I have like this measure that measures the quality of a product, of an asset, you kind of can do a more qualitative way and do some kind of portfolio stuff. So generating portfolios historically, and then changing that portfolio based on like these quality measures basically. And again, look ahead bias is really important to be removed in backtesting, because like you kind of need to be careful that none of the information you couldn't have back then enters this backtest. Issues we kind of have with backtesting is generally, this is also something mentioned in the book, you kind of want to always use backtesting for evaluating a strategy and not for finding a strategy. So you kind of want to have, this is again like this kind of avoiding overfitting thing. You kind of want to generate your strategy, your idea about the market based on your research, and then you want to backtest. And as it is like proposed in this book, typically you would have even two different people who interact as little as possible with each other. One that comes up with the strategies, and one that is just testing them, if they work and if they not work. And if they don't work, then try not to go back and tweak the model until it fits, because that is like destined to overfit. Generally, as I said, there is always some kind of look ahead bias and different kind of biases. So backtesting technically will, like, however good your results are, they typically in reality will be less good. So you will always overstate kind of what you by nature will almost always overstate what you would have gotten in terms of returns. Yeah, that is that. So this is kind of an interesting thing that I like to show people sometimes in terms of time series as well, because I don't know if someone wants to guess what I took that from. But basically, that's random. That's randomly generated data. It's completely a so-called random walk. So basically, every time you, at every point in time, you just pick a random number from a normal distribution. So between like, I don't know, 2 and -2, and add that to the current position. And to me, it's always been fascinating that this generates. Here's the code. It's basically just a few lines of code here to simulate that, and I feel like it looks amazing, like a time series. And you could even do a lot of maybe like technical analysis, right? Like it hit like a bottom here, then it wasn't able to generate a lower low, and now it's probably getting up if it's out of this trend canal and stuff like. It's still like kind of possible, and this is kind of what I see sometimes in terms of especially this kind of technical analysis with all its methods and stuff, that a lot of the time you can just you're just fitting that in hindsight, and it's random patterns that look like something, but it a lot of the time isn't. And I'm not saying that technical analysis doesn't work, especially in crypto, where you typically don't have good valuation models to tell you what Bitcoin, for example, is actually worth. Technical analysis often is the only way to go, basically, with its like moving averages and stuff like that. But it's to me, it's fascinating how actually random noise can look like something, and that's something you should always have in the back of your head. Like maybe it's really nothing; it's just noise, randomness.
One question here.
Yeah.
So, are there kind of general approaches or methods to try to prove that something is not random, or you just look at it and
I mean, this whole process of like model definition and then kind of like in statistics, you would generate your theory, and then without much overfitting, try to just generate the model and then fit it and see if it fits, and then if not, you're not retrying something on that. That is generally to just avoid that kind of overfitting in a sense. And all these processes I was talking about in terms of like machine learning, how you kind of don't want to have too much overfitting on your testing data and all that. This is kind of all kind of security measures to have that not come into your model, basically. But in general, I think it's difficult to find out what really is something and what is not, because I mean, we see that in crypto especially, right? Is it really some kind of pattern or something, or is it really just random? Some whale just threw in a bunch of millions and that's that. So
Okay.
this basically is like the big issue, the big question of like, how do we figure out what's random and what's not?
Thank you.
Yeah. And so there's kind of this thing that generally, like Ricardo will tell you more, hopefully next time in a talk, that is called modern portfolio theory, which is kind of I feel like the economist's way of coping with that. How maybe we can't predict anything. So how do we deal with that? And the answer is this so-called modern portfolio theory, in a way, which argues you kind of want to diversify. First of all, you kind of want to put your money into a lot of assets that are hopefully as uncorrelated as possible, so not moving together. So if one thing basically drops a lot, the others are unaffected by it and maybe will go up and counter out some of these movements. So in the end, you would have a more stable investment, basically. This is like the whole idea about portfolio, but Ricardo will tell you more about this. But yeah, this is like another approach, another way of dealing with that. We're also like using this in terms of portfolio generation. We have this research on investing in uncorrelated crypto assets, and in generally, this is also like a bit of I find always like this kind of dirty secret in banking and finance, that a lot of bankers just know. Modern portfolio theory is trying to is suggesting you kind of want to have a high risk, high performing asset that is not correlated with any kind of other market. And that cool thing that you're looking for basically is Bitcoin. So because Bitcoin is very uncorrelated, crypto assets are highly correlated with each other, but they're not very correlated with other assets, other stocks and bonds and all that. So this is kind of the thing that banks can tell you crypto is cool, but they also kind of want to invest in it because actually their theories are supporting that it makes a lot of sense. But yeah, as I said, Ricardo will talk a bit more about that. So in the end, I kind of want to like just give one example of the research that I'm currently doing, which is kind of a fundamental model. So it's basically not trying to predict returns, but trying to predict like the total value of a currency, in this case Bitcoin. And the underlying idea was basically there's this thing that's called, generally you have the issue of how do you value something like Bitcoin? What's Bitcoin worth? And a lot of people are trying to come up with some ideas on how to do it more or less successful. And there's such a thing as like this Metcalfe's law, which is about networks, basically, like social networks, for example, Facebook, which is saying the value of a network grows quadratically with the number of its participants. Saying, at least to a degree, it at least is dependent on the amount of people who use it, actually. So my idea in this case was let's try something similar. Let's try, as I said, like not overfitting too much by looking all kinds of metrics and stuff, but really just to come from a theory, basically, and let's say let's define the value, the market cap of Bitcoin as a function of how many people are using it, which in our case would be the daily active addresses as kind of a proxy for that. How much value is being transferred, which is like the transaction volume in this case. And then as kind of this how much, to a degree, how much work is being put in outside, and like kind of a community buzz sensor. I've also added the GitHub activity. And this is basically the model definition, like how you write that.
Just one thing, community bus is not GitHub activity, it will be social volume. It's like a bit different metric.
No, it's like more of what's going on in the inside, in the core team, because the GitHub activity is also not the dev activity, so it's but yeah, it's also not perfectly the buzz in the total community. It's more in the what's going on in the core team of Bitcoin, basically, as far as I understand it.
I think so. The GitHub activity it includes changes of the source code, but it also includes comments that people are doing in GitHub, or creating issues, or pull requests, creating pull requests, closing pull requests. So I guess it can be used as a proxy of at least part of the community that is interested in Bitcoin, but not.
It's it fits. I would say it's a dev social. Whatever you call it. And there is a non-dev. Let's call it dev social activity or hyphen non-dev social activity. It will be, I think, quite precise.
Yeah, but I think like one way or another, it kind of makes intuitive sense, at least to me. So this is like, as we've seen before, like this would be some kind of the output of this kind of multiple regression thing that you would put in. So we have kind of a nice R squared. It's not hugely high, but it's like it definitely is showing us all the added variables, like the daily active addresses, GitHub, and volume are significant, meaning they add some value to it. And the R squared is basically how much variance is explained, and like 0.7 is definitely decent. So it's like 70% of the variance is explained. And this is basically the prediction that I got out of it. So the previous dates, like from 17 up until like the mid 18 here, we were doing the testing of the model, so the training of the model. And then for this is trying to predict the value. So the orange line is the true value, and the blue is the prediction of it. And what I kind of really liked about this was that a lot of the time you have these things where it definitely moves before the actual value moves. Here not so much. Here it's like moving together, but then it definitely shows for a long time it's showing increase, and at some point market cap actually moves up with it. So I really like this as kind of a possible, maybe even like a bit predictive thing. And then you have your drop actually that is being predicted, and like behold, a few days later it actually dropped. So kind of interesting. By the way, here like I did a few changes. I basically did the log of all the features to because I felt like this worked better. And I did something called the Granger causality test, which basically is estimating, does one variable move before the other, assuming causality basically. So one moves and then the other moves, meaning this kind of has influence on the other. And we got significant p-values if we smooth the prediction a bit. So this just mentioned that I kind of smoothed that a bit, and then you actually get significant indication that might be some kind of predictive power in this, which is really kind of cool, I think. And then you would do on top of that, like following this kind of structure that I showed before, then you would do kind of a back test. So you would kind of, the strategy based upon that would be, okay, I have this true market cap, the true value of Bitcoin moving, and then I have the predicted one, which is saying, okay, that's how it should be. And so, of course, what I can do is I can say, like, every time my predicted value is higher than the actual, so it's saying it should be higher, I kind of want to buy Bitcoin. And if it's below that, I kind of don't want to buy. And when we test that, blue is again the returns of the strategy, and red is, orange is the holding Bitcoin. You actually perform quite nice because you're not being invested in some of the down phases, and you're in on the big interesting bull runs basically. And in terms of like how to interpret this would basically like be the return, the cumulative return. So it starts at 1 by definition, and then it would tell you if you had invested $1, for example, what would you have made? And in this case, blue would have turned $1 in $1.93, and the performance, like the benchmark, would stay at 0 more or less for this period of time. Of course, this is also kind of interesting to mention that backtests are extremely dependent on the time frame that you're looking at. So you kind of need to be aware of that. That you kind of, at some point you just know the performance of Bitcoin and the market and all that so well that you kind of like say, I can almost choose my time frame to get the returns that I want to, which is of course dangerous. Yes, this is kind of what we need to watch out for. But yeah, so this would be kind of like a.
Can you go to the previous slide? No, the one before. So I think what I kind of noticed that the only place that I see where the prediction goes wrong. So this is November 2011. So according to the prediction, the price of Bitcoin should go up, but it actually went way down.
Here, yeah.
Right? Sorry, 2018 November.
Yeah.
And like this is kind of, I guess, good for this model because we believe that in this situation, the reason why the price went way down is because of some whales that started selling. I mean, I think we have kind of a conjecture what happened. So because of the fork of Bitcoin Cash and Bitcoin SV, so and because of the fighting between the people there, they needed a lot of money to increase their hash power, so they started selling a lot of Bitcoin. And so this is what pushed the price very seriously down. But this is something that is impossible to predict using such a statistical model. So you cannot really, I mean the big whales that hold a lot of Bitcoin, it's not really possible to predict using statistics what will happen in their mind. Unless there are many of them, many of those whales. But aside from this case, it looks like it's mostly more or less correct from what I see on the graph, like just visually. So that's very nice.
Yeah, exactly. So that's actually really interesting. Yeah, with the drop. Of course you can predict something that is really just, as I said, like whale movement or something that no one can predict. So I was also like of course, kind of needs to be taken with some caution and all of that because it's like time frames can differ, and depending on, of course, like how long back you train your model, you get some kind of variation in the results. But I really kind of like this, and in the end, basically, what I think typically what you're trying to model is actually also not the truth in a way, but what you're trying to model is what other people think is true. And that's also why I kind of like also these more simple, multiple regression models, for example, because that's what the finance people are using. They're not using the deep neural nets or the machine learning a lot. They're using the old kind of statistical model. So this is also kind of
so one last remark from me for now. So here you try to predict the market cap using the logarithm of the three other features like daily active addresses, volume, and GitHub activity. So, so on the left you don't predict the logarithm. You try to predict the market cap. Does this matter if you take the logarithm or not here, or no?
You're talking about the log.
Yeah. So you choose logs on the right, and there's no log on the left. I noticed that. So I'm just curious.
Yeah. So basically, I tried a few things like generally like for this R squared, for example, for the model fit. It helped when I did like a moving average over the features of the daily active addresses and so on, to smooth it a bit. That got me higher R squared, but I felt like the logs looked way cooler in terms of actual predictive power. And typically in finance, a lot of time you look at the logged stuff to remove, to get something a bit more normally distributed, to remove some extreme values or to dim them down a bit. But yeah, in this case, I kind of, you're right, maybe I could have also looked at like predicting the log BTC value. Haven't done that yet, haven't tried that, to be honest. Because I kind of wanted to predict the real thing in the end. Oh, so yeah, but that of course is like needs to be mentioned. I guess that this is for the moving average model. If I do the log model, it goes down to I guess like 0.6 something. So it goes a bit down, but it's still kind of also kind of makes sense to me that sometimes you don't want to go for the best model fit, because if the truth is not really, like this kind of like predictive, like wobbling around it, you kind of want to go more for the predictive, and that might not be the one with the highest model fit. Daily active addresses definitely to my I'm not sure which one of those is the most important in this case. You could try to do something like a feed forward thing where you add and remove these features to see what improves the most. I guess I think it's daily active addresses the most, because you also have a high correlation in general, daily active addresses to price or to market cap. Then GitHub, and then volume, I think.
Are they weighted or like equal?
Sorry?
In the model. In the model, are they weighted or equal?
So basically what it does is to add like the kind of the coefficient, coef in the thing. I don't know if you see my mouse cursor.
Yeah, I see.
And these are basically the weightings for them. So you add them together and weight them by some kind of coefficient. Yeah, so they are weighted.
So basically, this linear regression stuff is this is precisely the question. We want to find the weights, which is more important and less important, and how important it is.
Exactly. So it's really actually like just summing up the features and like weighting them.
Machine does it kind of by itself. She finds out what is more like what is less.
Exactly. Yeah.
Cool. Coming back, Sanka, to your comment, because I was in a very noisy area, could not comment regarding November. For us in the future, let's not use as a reasoning Wales, government, China ban. It's all result of something else. Yeah? Because if we start doing like this, we are like surrendering ourselves to conspiracy theories, which I don't believe. And whales are humans, all government organizations, they do this stuff because of other things. They're not just manipulators, they're actually if they see big prices, whales, yeah,
I mean,
they will try to do something.
yeah.
If they see lower prices, they will do something.
Well, of course, but I mean, let's imagine, for example, I get that we do this analysis on the Sun token, and let's imagine that I get sick and I need money for treatment and very quickly, and so the only way to get money is to just sell all my Sun tokens immediately, and I just don't have other choice. So I can do this, and because of the fact that our token is not so much traded, so this will cause a very big change of the price. So this is so I'm a small whale for the Sun tokens, and this whether I get sick or whether I do not get sick cannot be predicted using statistical methods like the daily active addresses or the volume of Sun tokens or the GitHub activity of Sun tokens and so on. And I think here is something like this happens. So there are events that we cannot really predict.
Sanka, wait a second. I do agree with you. It's a very good point. The models we are building, they will be different for liquid and illiquid markets. In liquid markets, it has no impact. If someone gets, I don't know, become crazy or like in your example you mentioned, it has no impact on the market. What has impacted is human behaviors, and they behave when market be crowded and liquid. It has some specific models which explain it, not all the time, but what we are building should work, and we should not do conspiracy theory. But for your example, it's actually perfect, because I agree with you. In small markets like us, it's the models, they might work, and then suddenly at some point of time, no working at all, just because of the reason you say. Yeah, that will be true. Not for Bitcoin.
Well, I'm not sure.
Bitcoin,
Bitcoin, there are some big holders, which they do not want to move the price too much, of course, but in some special situations they might do that. If for imagine Satoshi comes out of retirement and then takes all of his bitcoins and tries to do something, so this can cause a very big change. Yeah, and it starts with one person. Yeah, so it's kind of, it can be chaotic. Like it can be not really
possible. As I say, it's predicting is in general like the most complicated things, because we don't know the future and we don't know what will happen. Just about modeling things and explaining things with when we explain this human behavior, we should stick to it unless it's proven otherwise. So yeah, this is it. Anyway, it's we will keep coming to this topic that's more deep and complex thing. I spent like 5 years to really deeply understand all this behavior analytics and how people constantly fall into the trap of conspiracy theories. Like I've seen it hundreds of times, and there is only very few people who like stick to understanding there is no conspiracy. There is always human behavior or crowd behavior behind, and that explains most of the things in a liquid market. In a liquid market, in a liquid, I agree with you. Yeah, that's random thinking. No explanation here. Okay. Anyway, so just wanted to make sure we at least plant the seed for the future discussions or talks on it.
Okay, thanks, Jan. So, are there any questions?
Yes. So Jan, I didn't give a feedback about the last model. This like BTC with the elective addresses volume on GitHub. So have you checked the distribution of the residuals of the model?
Come again?
Did you check the distributions of the residuals?
No, sorry, yeah.
Yeah,
But you're right,
because
that might be actually interesting to look at.
actually that might be a big problem, because if you come back to this describing slide with all statistics, yeah, you see that your Darwin-Watson criteria is 0.03. That means that you have extremely high autocorrelation with lag of 1. So that probably means that this model, it's, I mean, not the model, but the statistical, this all statistical stuff, it's not actually right, because one of the, I don't know how to say it in English, this, maybe some Russian guys help me, предпосылки МНК.
Assumptions. Some of the assumptions.
Yeah, these assumptions of ordinarily
least squares errors.
Yeah, least squares errors. It's not working. So probably these coefficients might be wrong. So that's something worth to check.
Yes. So generally, I think this thing is we're not having stationarity, for example, in this case, simply because we're not using the returns in this case. As I said, like this is typically what we go for, but there is like this kind of idea of since it's not trying to predict returns, basically, it's trying to generate like some overall value. Yeah, so generally, yeah, you're right. Durbin-Watson looks not so good in this case. Might screw with some of the significance tests and all that. But in general, yeah, I still think, you know.
Yeah, I maybe would suggest you to take differences in the time series and take the logarithm of the differences. That's something we did in university. So that sounds like a bullshit, but from statistical point of view, that helps to remove all the autocorrelations. So
the thing is, then we're typically back at this this station of then we're just trying to more or less predict the next state, and this is kind of also the issue that was like raised, for example, in this book, that it's again not the greatest thing to just try to predict the next state.
yeah, no, but like if you predict this, so then you take the logarithm again and add the difference. So that's possible to use it for next day predictions.
Cool. Yeah. Let's maybe talk about that more.
Okay.
I'll try this. Yeah. Cool. Thank you.
Yeah. So we can talk about it later.
Yeah. I'll call you.
Okay.
More questions?
Maybe not a question, but a thing that in Bitcoin there are a lot of these intermediate addresses, and if you count the elective addresses, that's not actually the best idea. That's not like that's all our fault because we don't have this in Santiment for now. But maybe if we count real users, that would be much more sufficient way to calculate daily active, like the activity of people who transfer bitcoins. So, but that's for next things, for next seminars.
That is true. Yeah, it definitely is only like a rough proxy of it. But then again, it would kind of like the regression would kind of scale that down, I guess, to a degree, if
Yeah.
it's just growing, by a scalar, basically.
The same argument goes for the transaction volume. Because the transaction volume is not like the GDP, there are technical reasons which inflate the transaction volume, and that's why we have this circulation metric, and other people have tried to do things like this also, to reduce the technical reasons that inflate those numbers. But I think even now, so the number of daily active addresses is most probably correlated with the number of users, and the transactions volume is probably correlated with the actual GDP. And I think you can see this especially for daily active addresses. When you open the graph, you see that there's a weekly pattern, which to me means that those transactions are initiated by humans. So this number is not exactly equal to a number of users, but it's some kind of a multiple of it.
Yeah, I would agree.
Cool. All right.
Okay.
Any more questions?
So if there are no more questions, then thank you to Jan for this awesome presentation.
Thank you all for your attention.
Yeah, and we'll meet next time. Okay.
Okay, cool.